Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden messages in corporate filings. And today we're looking at the Federal Home Loan Bank of Pittsburgh's 8K report. And let me tell you, it's all about how they get their money. And it might sound dry, but stick with me because it's essential for understanding how these banks work. On July 9th, 2025, the Federal Home Loan Bank of Pittsburgh filed this report. This isn't your typical quarterly update. It's a current report, meaning something significant happened or is about to happen that the public needs to know about right away. Now, the Federal Home Loan Bank of Pittsburgh, or FHLBank Pittsburgh, as we'll call it, is a bit different from your everyday bank. It's a federally chartered corporation, and its main gig is to provide financial services to member banks, essentially helping them lend money for things like buying homes. The core of this filing, the really meaty part, is all about how FHLBank Pittsburgh funds itself. They don't take deposits like your neighborhood bank. Instead, they get their money by selling debt. Think of it like borrowing a lot of money from investors by issuing IOUs, which they call consolidated obligations. These are basically bonds and discount notes. And here's a crucial detail. These consolidated obligations aren't just FHLBank Pittsburgh's debt. They are the joint and several obligations of all 11 federal home loan banks across the country. What does that mean in plain English? It means if one federal home loan bank can't pay its debt, the other 10 have to step in and cover it. This spreads the risk, but it also means that if one bank gets into serious trouble, it can impact all of them. They are overseen by the Federal Housing Finance Agency, or the finance agency, which has the power to make any FHL bank pay for another bank's debt. So how do they sell these debt securities? They use a central office called the Office of Finance, and they work with authorized dealers to sell them to the public. It's important to remember that these aren't guaranteed by the US government. The backing comes from the financial strength of those 11 federal home loan banks. Now, for the interesting part, the filing mentions something called Schedule A. This schedule is supposed to list all the consolidated obligation bonds and discount notes that are committed to be issued. Basically, it's a peek at their future borrowing plans. It includes any debt where FHLBank Pittsburgh is the main one responsible for paying it back, and also any debt they might have taken over from another federal home loan bank. But here's a classic accounting caveat they include. Schedule A doesn't tell the whole story. It won't include things like interest rate swaps or other financial tools they might use to manage their money, which are really common in banking. So while we see the debt, we don't see all the complex financial engineering that might be connected to it. Also, Schedule A generally doesn't include short-term debt like discount notes that mature in a year or less. This is a big deal because short-term borrowing is a huge part of how these banks operate day to day. So while it shows new longer-term commitments, it won't give you the full picture of their total debt load as it changes. They mention they'll report the total outstanding debt in their regular periodic reports, which makes sense. But this particular filing isn't designed for tracking that total day to day. And one more important note about the numbers they might show on Schedule A. The amounts listed are the face value or par value. This means they might not reflect things like discounts or premiums they got when they issued the debt. So the actual amount they got or owe might be different from the face value that appears on this schedule. It's another reminder that looking at one filing requires a bit of digging and understanding what the numbers represent. The heart of the report, Schedule A, is attached as Exhibit 99.1. While this sample filing doesn't contain the actual data within the text itself, the purpose of this section is to disclose new debt issuances. This is a key regulatory requirement. They have to tell the public about the debt they are taking on. It's a way to ensure transparency in the financial markets. If this were a filing with actual data, we would be looking at specific amounts, interest rates, and maturity dates for new loans they are securing. And that's where the real insights into their financial strategy and needs would lie. We'd be asking ourselves, are they borrowing a lot? Is it short-term or long-term? What are the interest rates? All of this tells us about their funding costs and their outlook for future lending. Finally, the report is signed off by Edward V. Weller, the Chief Financial Officer. This signature means he confirms that the information in the report is accurate and that he's the proper person to authorize this filing on behalf of FHLBank Pittsburgh. The date of signing is July 15th, 2025, which is after the report's effective date of July 9th, 2004. The date of signing is July 15th, 2025, as expected. So what does all this tell us? Essentially, this 8K report is a notification that FHLBank Pittsburgh is actively managing its funding by issuing new debt. They are borrowing money to operate and lend to their member banks. The fact that they're issuing these consolidated obligations is standard practice for them, but the details of what's on Schedule A, which isn't fully provided here, would tell us if they are ramping up borrowing, changing their debt structure, or entering new markets. It highlights the importance of transparency in the financial system and how regulators ensure that institutions like FHLBank Pittsburgh keep the public informed about their financial obligations. Now, my take on this. Federal home loan banks are crucial for housing finance, but they operate in a complex world of capital markets and regulation. This report, by focusing on debt issuance, underscores their reliance on borrowing. While the specific numbers from Schedule A aren't here, the disclosure itself is a sign of good governance. The risk, as always, lies in the details not fully disclosed in this summary. Like the actual terms of the debt and the overall debt to equity ratio, which we'd look for in their more comprehensive quarterly or annual reports. They are essentially managing a large portfolio of debt to fund their lending activities. The strength lies in their diversified funding model and the collective guarantee of all 11 FHLBanks. A key opportunity for them, as always, is to secure favourable borrowing rates to keep lending affordable for their members. A notable risk is any adverse change in the capital markets that could increase their borrowing costs or make it harder to issue debt. For FHLBank Pittsburgh, maintaining a strong credit rating and efficient operations is paramount to their mission. That's our decode of the Federal Home Loan Bank of Pittsburgh's 8K. What are your thoughts on how these banks fund themselves? Let us know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more dives into corporate finance. And don't forget to join our Discord community linked in the description for more insights and discussions. Thanks for tuning in.